The IRS has 3 ways to take a bite out of your retirement. Here's how to keep each one small. The first bite is federal income tax, applied to your pension, to most of your Social Security, and to every dollar you pull from a traditional TSP or IRA. The second is state income tax, which, depending on where you live, can take another 10% off the top or nothing at all. The third is the penalty tax, 25% of the amount you should have withdrawn if you miss a required minimum distribution. 3 bites: federal, state, and penalty. Over the next 10 minutes, we'll walk through how to arrange your retirement paycheck so the first bite is as small as the law allows, the second one is managed with intent, and the third one never happens. Then we'll talk about 2 threats that are not about taxes: debt on fixed income and inflation over a 30-year retirement. Bring your numbers. Let's protect what you earned. Most military retirees in this room have 5 possible income streams, and understanding how they stack is the first step to managing them. Stream 1, military retired pay. Taxable at the federal level, adjusted annually for inflation. Stream 2, VA disability compensation, tax-free at every level, also COLA adjusted. Stream 3, Social Security, partially taxable depending on your combined income, starting anywhere from 62 to 70. Stream 4, withdrawals from TSP, 401k, or traditional IRA, taxable as ordinary income. If any of it is Roth, that portion is tax-free. Stream 5, employment income, a second career, consulting, part-time work, taxed like any wage. Stack those 5 together, and you have your monthly retirement paycheck. Here's the key insight. You have more guaranteed COLA-adjusted income than most Americans ever see. The 4% withdrawal rule, the rule of thumb for private sector retirees, doesn't apply as strictly to veterans with a pension floor. The question is not whether you have enough. The question is how to keep the IRS from taking more than it has to. Federal taxation of your retirement income splits cleanly into 2 buckets: taxable at ordinary income rates, military retired pay, the taxable portion of Social Security, any withdrawals from traditional TSP or IRA accounts, and any wage income. That bucket fills your adjusted gross income and determines your tax bracket. Tax-free, VA disability compensation, every dollar. Roth IRA withdrawals after age 59.5, every dollar. A portion of Social Security, depending on your combined income. The strategic insight. Because VA disability is tax-free, it reduces the pressure to draw from taxable accounts. Every dollar the VA pays you is a dollar you don't need to pull from the TSP, a dollar that stays deferred and growing, and a dollar that doesn't push you into a higher tax bracket or trigger an IRMDA surcharge on your Medicare premium. Veterans who understand this stack their withdrawals intentionally. They draw less from taxable accounts in high-income years, more in low-income years, and they use Roth conversions during gaps. That's tax-efficient income management. State tax treatment of military retirement pay varies dramatically across the 50 states. 9 states have no state income tax at all: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you retire in any of these, your military pension arrives untouched by state tax. At the other end, a small number of states fully tax military retirement with no special treatment. California is the most notable. Most states fall in between, offering partial exemptions, deductions, or age-based exclusions that reduce the hit. For this group, here in West Virginia, the news is good. West Virginia fully exempts military retirement pay from state income tax, regardless of age or income. That exemption was passed in 2018 and continues today. If you live in West Virginia and you're drawing a military pension, the state takes 0. That can mean $5,000, $10,000, even $15,000 a year kept in your pocket compared to a state like California. The planning question: is it worth moving for the tax savings? Sometimes. But watch the offsets. Florida and Texas have no income tax, but property taxes and insurance premiums are high. A move that saves $3,000 in income tax but adds $4,000 in property insurance is a losing trade. Run the full number before you relocate. Required minimum distributions are the IRS's way of saying, you deferred tax on this money for 40 years. It's time to pay. Starting at age 73, if you were born between 1951 and 1959, or 75 if you were born in 1960 or later, you must withdraw a minimum amount from your tax-deferred accounts every year. That includes TSP, traditional IRAs, and 401(k)s. It does not include Roth IRAs during your lifetime. The calculation is simple. Account balance on December 31st of the prior year, divided by your life expectancy factor from the IRS uniform table. Miss the deadline, and the penalty is 25% of the shortfall. Take it correctly, and you just pay ordinary income tax on the amount. 3 strategies matter. Consolidate accounts. Fewer accounts means fewer calculations to track. Take the distribution early in the year. Do not wait until December and risk missing the deadline. And consider Roth conversions in the years before RMDs start. Converting traditional dollars to Roth during low-income years reduces the balance subject to future RMDs. You pay the tax now at a rate you control instead of later at a rate the IRS and the calendar control. One trap: if you have multiple IRAs, you can satisfy the total RMD from any one of them. But TSP RMDs must come from the TSP itself. You cannot satisfy a TSP RMD from an IRA. The assumption that most people reach retirement debt-free is not supported by the numbers. 97% of retirement-age Americans carry some form of non-mortgage debt. 68% of retirees carry a credit card balance. The average credit card balance for adults 65 and older is $7,484. Here's why this matters more in retirement than it did in your working years. On a paycheck, high-interest debt is painful but recoverable. You can pick up overtime, take a second job, grow your income to dig out. On a fixed income, that lever is gone. Every dollar of credit card interest is a dollar taken from groceries, healthcare, or the things you retired to enjoy. 4 rules. Pay off high-interest debt before you retire, even if it means working 6 or 12 more months. Never tap the TSP or IRA to pay down credit cards. The tax hit plus the lost growth makes the math worse, not better. On a mortgage, run the arithmetic. Below 4%, investing the cash usually beats paying it off. Above 6%, paying it off is a guaranteed return. And avoid new debt in retirement. On fixed income, there's no earning power to dig back out. A 30-year retirement changes how you think about inflation. At 3% average annual inflation, the historical long-run average, $1,000 today is worth $744 in 10 years and $554 in 20. Cut your income in half over the course of your retirement, and that's what unmanaged inflation does. This is where your military benefits quietly shine. Military retired pay has an annual cost of living adjustment tied to the Consumer Price Index. VA disability compensation has a COLA. Social Security has a COLA. All 3 of your biggest income streams adjust upward with inflation every year. Compare that to private pensions. Most have no COLA at all, and purchasing power declines every year. Fixed annuities, same problem. Savings accounts, interest rarely matches inflation. The practical takeaway: your COLA-adjusted income is more valuable than it appears on paper. A $3,000 a month military pension today, adjusted for inflation over 20 years, is worth approximately the same in real dollars as it is today. A $3,000 a month private annuity over the same 20 years has lost half its purchasing power. Lean on your COLA-protected income. Preserve your portfolio accounts for inflation risks the government isn't already covering for you. Before next session, 4 actions. First, sketch your retirement income stack on paper. 5 lines: pension, VA disability, Social Security, TSP, or IRA withdrawals, any wage income. Mark which are taxable, which are tax-free, and which have COLA. Second, Confirm your state tax treatment. If you're in West Virginia, your military pension is exempt. Verify that's how it's being reported on your returns. Third, if you are within 5 years of RMD age, talk to a tax professional about Roth conversions. The window before RMDs start is the best planning window you'll ever have. Fourth, pull your credit card balances and calculate what it would take to be debt-free by retirement. If the answer is working 6 more months, that may be the highest return decision of your financial life. Next module, the last in this course, we close with legacy planning, the survivor benefit plan, which protects a spouse after you're gone, the pros and cons, the costs, and the decisions you make today that shape what your family receives tomorrow. Bring your questions. We'll finish strong.